You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. You wanted it. You got it. A radio program that helps teach you options trading inside and out, basic to complex. This is Options Boot Camp. Whether you want to learn how to protect your portfolio, generate income, or even become a master of volatility, your Options Boot Camp drill instructors, Mark Longo and Dan Passarelli, will break it all down for you. Fall in boot. It's time to get into peak options trading shape. It's time for Options Boot Camp.
All right, everybody, that music means we are back once again on Education Wednesday. Time to roll out the old drill instructor proving ground, because it is time once again for everyone's favorite. I know it's my favorite. It's probably your favorite show as well. A little bit of the old OBC, a.k.a. Options Boot Camp. What better way to kick off our new year? This January, listeners, marks our 17th year of doing this, which is absolutely crazy to say out loud. But what better way to kick it off than with a little double dose of Options Boot Camp? And it wouldn't be a little bit of the old OBC if I wasn't joined by my compatriot, my partner in all things boot camp crime, the black-hatted one to my white-hatted one, Mr. Dan Passarelli from Market Taker Mentoring. Mr. P, welcome back to the show for episode 2 of our New Year's doubleheader extravaganza, sir.
Well, it sure is swell to be back, and Happy New Year again, everyone.
Happy New Year indeed. Dan, I got so busy last episode with all of our fun stuff, I didn't mention our 5-star reviewer. So let me get to that now. Of course, if you like what you hear, this program, really any other program we do on the network, you like what you hear, throw a like, a star, a comment, a rate, all that stuff in aggregate, whatever platform you're listening on, whatever it lets you do, all that stuff does in aggregate help new people continue to discover the program. Last year, of course, our biggest year ever, and we're already trending strong into the new year. So if you like what you hear, you want new people to listen to it, head on over to your platform, leave a review, just like our 5-star reviewer this week comes from the handle Velveteen. I like it. It's a good handle. Maybe he's a Velveteen rabbit. He says, Happy New Year to my favorite pod. Well, there you go, Dan. We're his favorite pod in all the universe of pods. We are his favorite, sir. What say you?
Oh, man, I say that's great, and that's an honor. Thanks for listening.
Thanks for listening, indeed. Velveteen, everyone else who takes the time out there to give us a rating and review. We've been doing this for a long time, not quite 17 years on this show front, but over a decade for this show. So if you like what you hear, you want to keep the fun rolling. The new reviews do help people discover the show as we keep on rolling right on into a little bit of the old mail call.
Mail call. Time to look at questions submitted by our listeners.
All right, everybody, welcome to the mail call, the portion of the show where you folks take the reins, your questions, your comments, your insights, your pearls of wisdom. Before we get to those, listeners, you've been waiting all through episode 1 of our doubleheader. We have finally gotten there, Dan, the moment everyone's been waiting for, the Market Taker question of the week. What you got for us?
All right. So I get this one regularly, and I just got it this week. So it becomes the question of the week again. So the question is, what are the best market conditions for option trading? And, you know, now that I think about it, we actually talked about this a little bit on the last show. So the best market conditions are a volatile market. One that oscillates up and down. Now, ironically, that's when a lot of people move away from options. A lot of folks learn about options. They learn about selling puts, and they look for markets that are just going up, and they sell puts. And because volatility goes down and the stock goes up, they make money on Vega and Delta and time decay. And it's really, really easy making money with that one very entry-level strategy. But once you get better at options, and once you learn more about the inner workings of how options work, and you learn different strategies for different market conditions, the reality of it is you can make money in any market. And that is by and large the best thing about option trading, is that there's so much darn versatility. Whatever you see there on the screen, you can a lot of times construct an option position to capitalize on it. So I'm just going to, to sum it up, there's not really one single market condition that's best for option trading. There's a lot of them. It's a smaller subset of which ones are bad for option trading than which ones are good for it.
I'll give you a short answer to your question, Dan. The third week of February, best time for option trading all year. Just trade that 1 week and then go away for the rest of the year. And you're good, listeners. Make all your profits. This year, by the way, a leap year, Dan. So we have an extra day in February to, should be some studies on the profitability of leap year. First leap year with zero DTE liquidity. So there we go. It's going to be a madhouse, listeners. All right, let's get to it. It's not a madhouse, Dan, is our chat. They're just such nice folks. I was looking in here, and they saw Nichols chiming in saying, Happy New Year, Mark and Dan, too, and also super producer Gene, of course. So there you go, Dan, getting some love from our live list. Just a love fest there. They even like you, Dan, so there's no accounting for taste, sir.
Yeah. Well, that is...
It is mystifying. I agree. I am mystified by their love for you all the time. All right, let's keep rolling. Let's go out here to Joshy T, who wants to follow up. I think this was your question of the week last episode or a couple episodes ago. But Joshy T wants to know, Dan said short squeezes are alive and well on last week's show. Does that mean we should be strapping in for another 2021 meme stock run in 2024? And are we seeing any signs of that from a call skew perspective? So, Dan, I believe this was your question of the week a few weeks ago, where you said short squeezes are alive and well. So Joshy T heard that. He wants to know, should he be out there, loading up on all the upside in like GameStop and all that other fun again, sir?
Yeah, short squeezes are alive and well again. But, truth be told, no, I don't think we're in for another 2021 meme stock thing where like everything was just crazy. Like you could make money on short squeezes every week. But they are around, and we've seen a couple of good ones. I've been off for like a week and a half, so I can't think of an example right now. But there are some signs on some stocks. Again, can't think of an example off the top of my head, but last time I looked where, you see some of those upside calls bid on stocks that have very, very high short interest, which I define of above 15% of the float. The higher, the better. But no, Mark, we shouldn't be loading up on some of these things just willy-nilly because the calls are bid up and because they have high short interest, because people are short them and have conviction for their own reasons, and they will defend them. And it takes a lot of contagion in order to have a short squeeze happen. Somebody has to buy in a pretty big size, or a lot of retail people have to buy out at the same time in a pretty big size, and that's got to spook, at least one of the short squeezers to buy his or her shares back, and that's got to cause a gamma squeeze. Like, a lot has to happen, so we always have to wait until certain conditions are met, and that's why we look at the screen, at the volume. only when the stocks are up at least 1% on the day. Again, that's why I created Options Radar, because it does all that stuff for you, which would be pretty impossible to track just, doing it manually yourself with your own eyeballs.
Yeah, I'm with you. I don't think we're going to see the meme 2.0 anytime soon. That said, we've seen some explosions in certain names, and there certainly are interesting names to watch. The second part of his question, I think, is also interesting. He wants to know, are we seeing any signs of that from a call skew perspective? Well, the best way to check that for yourself, who wrote this, Josh E.T., is to go look at the skew numbers out there for the broad indexes. Let's say the S&P 500. That's where everybody's playing these days, right? We just had our buddy Mr. Matt from ORATS on the show a few weeks ago, back in a great covered call debate, so mid to late December. And he was saying then he thought the skew was pretty light at that time. And he was indeed correct. I'm looking at the 30-day at-the-money vol skew in the S&P right now, listeners. Right now it's hanging out at almost 25%. That puts it at about the 31st percentile historically. If you go back to that last show where Matt was saying things were pretty low, he was actually correct, because the 19th was pretty much the low for the year of overall skew. So that meant the puts were the least bid they've ever been at that moment. And the calls also weren't as crushed. So that was only about a 15% vol skew. The high for the year in terms of skew came actually on May 24th. If you go back and look at your S&P chart, listener, that's when we had a nice little dip. We were starting to threaten 4,100, maybe 4,000. People were getting a little bit spooked. They were bidding up those puts like they were going out of style. That level was 45.1%. So we're not quite there, but we're also not quite at the low we were the last time we chatted about this either. We're at almost 25%. So skew has firmed up a little bit, some of that having to do with these first few sessions of the year. We're seeing a little bit of a sell-off here to kick off the year, a little bit of red on the screen, so that's obviously playing into that number as well. But if you have questions like this, Josh T, if we're seeing broad macro skew calls getting bid, puts getting offered, you can go check this yourself too in a lot of the major indices. And right now, the answer is no. The skew was very cheap a few weeks ago during the height of seasonality. Not quite as cheap now, but still fairly inexpensive. Not quite at the May levels yet, but keep an eye on it. If we keep having these sell-offs here early in January, that could certainly change. People like to buy puts when the barn is on fire, right, Dan? Not beforehand. And so if the barn is on fire, those puts are going to get juicy. All right. Speaking of juicy, Dan, we got a good question here. Strap in. We got a crazy butterfly question. Are you ready?
Let's do it.
All right. This question comes from Gator and Crane. It sounds like a Southern law firm, doesn't it? The firm of Gator and Crane is going to represent me for my swamp boat accident. Gator and Crane wants to know, okay, they say, why does no one talk about bi-directional butterfly trades? Well, let me set it up. XYZ is hanging out at 10. You're not sure where it's going to move, so you buy an at-the-money call, then sell 2 out-of-the-money calls, then buy one more further out-of-the-money call, a.k.a. buy the call fly, maybe around the 10, 12, and 14 strike. So he's buying an out-of-the-money call, or an at-the-money call fly, effectively. Now, then he says you do the same thing for the put fly. Maybe you buy 10, 8, and 6 strikes. So now, effectively, you're long the at-the-money straddle, which, yeah, he bought the 10 call and the 10 put, so that would be the at-the-money straddle. And then short 2 each of the out-of-the-money calls. So in his example, he's short 2 of the 12 calls and short 2 of the 8 puts against it. And then long one more further out-of-the-money call and put. So in his example, he's long a 14 call now and a 6 put against it. He says, I get that buying the at-the-money straddle is expensive and suffers from decay. But am I crazy to think that this strategy is superior to the traditional iron butterfly? I think he meant to say which is just the long at-the-money straddle and then short a strangle against it. This gets you more short premium to offset the cost of the straddle, but also a little bit more room for the long straddle to run. Why don't I see this strategy discussed anywhere? Oh, he says, you have my permission to use this on your show. Maybe you can call it the Boot Camp Blowout Butterfly. I like that. Or something cool like that. And can we have Matt from ORATS backtest this strategy versus the Ironfly? All right, Dan, wow, a lot of moving parts here. We're kicking off the new year in high fashion. The law firm of Gator and Crane, bringing a good one, and I like it. But he wants, so he's trying to juice up your traditional Ironfly. Ironfly, listeners, we talk about it many times. You buy the at-the-money straddle. It's going to kill you, death by 1,000 cuts from decay, so you sell an out-of-the-money strangle against it. Pretty straightforward. talked about that a million times. This law firm here is trying to turn it up to 11 with their boot camp blowout butterfly. Now they're buying 2 flies in each direction. So they also put it as a bi-directional fly. You're buying the at the money straddle, Dan, selling 2 out of the money calls and puts against it, and then buying 1 more out of the money call, out of the money put against it. So effectively, you got 2 long flies based around that at the money straddle. It's the old, you make money in any market condition, Dan. What could possibly go wrong? I think this is going to be your new go-to strategy for 2024 for MTM. Prove me wrong, sir.
I mean, why doesn't anybody talk about it? I don't know why no one talks about it. I know for sure that I have modeled this thing out on previous occasions, but I don't remember ever actually trading it. I think I always found a way that I felt was better. But I don't want to make a general statement out of that. I am completely certain that there is a specific market environment where that's the perfect strategy, but I don't know off the top of my head if it would be a real common one that you can get a lot of use out of, because when you buy that first out of the money butterfly, it'll have some sort of risk reward, and the out of the money butterflies can sometimes have a pretty good risk reward. Like sometimes it's risk 1 to make 9, but that's best case scenario. And I'll come back to that in a second. But then when you buy the other one, now you're risking 2 to make 8 on each. Presuming that you do them both at about the same price. That extra spend reduces the maximum profit of both of them. Now, back to that idea of maximum profit, that's only if it's in the exactly perfect location at expiration, and we never really count on that. Those rare times when it does happen, it's just like a free gift. But usually it's somewhere sort of in the bottom third of the profitability range, which can still be great risk reward, but it gets a little worse when you have 2 of them. So I don't know. Look, I mean, the one advice that I give to all of our student traders at markettaker.com, as well as on this show, is when you're analyzing a trade, always look at 3 different ways to trade it. So here you're looking for a stock to move. So, but you don't have an opinion about direction. So great. Model this out. Model out a plain old straddle, plain old strangle. Maybe even model out buying a iron condor or something. And just see which one of those makes the most sense. Like you can start trading this and looking for stocks to trade this with, but before you pull the trigger on it, look at other alternatives for that and see which one is better. And I don't know what the answer will be. I suspect that you'll get different answers at different times, but I don't know. I mean, the reason I don't talk about it is because I never really spent too much time considering it.
Yeah, I'm like you. I'm sure I've stumbled across this playing, doing trades in the past, or I've modeled something else. Oh, it ends up working out something like this. I don't think I've ever done it either. But it is an interesting idea. At the end of the day, you're selling an additional vertical out of the money, right? That's what you're doing versus a traditional iron fly. So the question becomes, does selling 2 additional verticals, does that extra amount of premium, does that offset the decay enough to be worth doing? And does that materially impact the performance of the strategy? That would be a good question for Mr. Matt from Orats and his Rogue AI Auto. They could crunch those numbers and give us a definitive answer. It is an intriguing idea. If the iron fly intrigues you, then maybe selling another vertical also intrigues you. And then you hope that one of those ones works out, the other half doesn't, and then it ends up having a little bit more premium to cushion you against the death by 1,000 cuts that is the at the money straddle trade, which at the end of the day is the core of this trade, right? It's intriguing. It might be an interesting one. Next time we have, who wrote this is the law firm of Gator and Crane. Tell you what, law firm. The next time we have Mr. Matt on, I will specifically ask him to analyze this versus just a traditional iron fly, because that's what you're comparing it to, and see if the extra effort, the extra legs, the extra cost, there is some extra cost to doing that, if all of that is worth a little bit of additional premium you're getting, and if that materially impacts the overall or not. I don't hate this. I don't. Maybe I think it might be much to do about nothing at the end of the day, Dan. I don't know if you're getting a ton of extra. Again, it kind of goes back to what names you're doing it on. Are they crazy put skew, crazy call skew? What kind of name you're trading it in? It's going to perform differently in different names. But it's an intriguing idea. I don't hate it, Dan. I'll give it that. I don't hate it. Is that damning it with too much faint praise?
No, I mean, I guess I'm with you there too. Like I said, I'm sure that there's going to be at least one time where you model that out and you're like, yeah, man, this is exactly what I need to do. It has the best risk reward versus what I think is going to happen. But I don't know. Yeah, I don't hate it either. I guess if you learn something from it, and the compliance officer at your law firm allows you to share it, throw it back out there for us and tell us the results. I'd be interested in hearing about it.
These lawyers, they're done with law. They're going to go into their blowout butterfly trades, and that's how they're going to make their living from now. I like it. So don't sue us yet. We don't have a specific exact answer, except that we don't hate it, but we want to crunch the numbers on it. But it's an intriguing idea to kick off the new year. Speaking of kicking things off, we have this question. I don't see who sent this in. They don't have their name here, but they gave us some feedback on our recent episode, Dan, the great covered call debate. I had you and our buddy Matt from Orats just locked in a battle to the death of covered call versus not covered call. You were saying you wanted to do nothing but sell covered calls till the end of your days, and Matt was calling you an ignorant buffoon, and I had to step between you. Luckily, you were thousands of miles apart to keep you from coming to blows because it was that contentious, listeners there. But we have this listener who's unnamed here. I don't see their name, saying, "Hey, dudes, saw this tweet come across my timeline as I was listening to your great covered call debate. Talk about serendipity. Happy New Year to my options faves," or Happy New Year to you as well, whatever your name is, a mystery person. But they sent in a tweet from somebody, I'm not familiar with this person, Ron Israelov. He's a quant at a firm called NDVR, and he happened to post this thing, Dan, called "A Devil's Bargain When Generating Income Undermines Investment Returns." And this is a paper that I guess he and his team put out back in October of last year, and I have the abstract here. The abstract says, many investors are motivated by passive income. Dividend income-seeking strategies have a long history. More recently, interest in derivative income strategies such as covered calls and put underwriting continues to develop. Do high derivative income covered calls tend to deliver higher total returns? No. In fact, the relationship goes the other way. We demonstrate a strong negative mechanical relationship between expected total return and derivative income for covered call strategies. We empirically validate this relationship over a nearly 25-year period on the S&P. Covered call strategies, those who have sought out and allocated to such strategies without accounting for this trade-off might have made a devil's bargain, Dan. So there you go. Our covered calls, the devil's bargain, Dan. Man, that's strong language, sir.
Oh boy, that sure is. I mean, geez Louise over here. Well, yeah, I mean, I guess I'd have to read this. It can be hard reading white papers.
Yeah, they don't. The abstract jumps off the page. I don't know if the rest of the paper does. We'll have to see. Yeah,
exactly. So, yeah, I mean, it's interesting. I've definitely seen studies that show either way, and I've been able to pick holes in both ways. So, yeah, I don't know. I mean, I don't have anything but empirical evidence to back this up, but I think it depends on how you do it. I think that if you do it in just a pure, backtest way, because backtesting, you're usually using the closing price. I think with ORATs it's 15 minutes before the close of the day. It doesn't give you a whole lot of time to or it doesn't give you a whole lot of flexibility in your management doing it that way, and I have found that management of covered calls is key. I mean, you have to have a set of rules. You can't be doing it willy-nilly, but I think it's probably pretty hard to program those rules into a backtesting thing, or to have it simple enough to generate results in a white paper. I don't know. That's just my observations.
Yeah, I haven't read beyond the abstract here. I'll have to sink my teeth into this and see a little more about, you're right, what their methodology is, how they're tracking this. Are they just writing the call and letting it expire and then doing it again next month? Is there some active management they're in? That, of course, the devil lies in the details there. But intriguing, maybe more data for those of you out there who are maybe a little bit skeptical about covered calls. There you go, Dan. You have made a devil's bargain by selling covered calls. All right, since we're talking about our covered call debate, a lot of you had interest in that. We'll get out of here on some love for that episode from a couple of listeners, Diver SK and Just John. Diver SK sounds familiar. He's written in the past with some strategies. He wrote in to say he just listened to the great covered call debate and some of the other episodes, and he put in an AMC. He is starting a new strategy that he heard on our podcast discussing the wheel. As I have a ton of shares sitting, so he's sitting on a bunch of shares in AMC, it sounds like. I still want to play, so I'm selling now weekly at the money puts. He puts in parentheses at the $6 strike. Just closed today and open next week. When I'm assigned, I will then sell the 70 delta in the money call. I'm going to post my weekly yields. We'll do this for a year on AMC. Current yield on week 2, he says, is 145%. That's pretty robust. This should now reflect the actual progression of a weekly yield. I'm also doing this on another platform, but only selling 2 week out, 14 days expiration. He says, I'm doing the wheel strategy since 2001, so nothing new, but the constant flipping at in-the-money short call delta 70 is new. It seems like it might work, especially starting at the bottom. He says, credit goes to Matt from our last show, who he always enjoys immensely when he comes on the network. Again, no accounting for taste, Dan. People like you, people like Matt, people have terrible taste, our listeners on the network. So that he was putting that out there to the world, and then Just John chimed in. He wanted to know if he had a link to the specific episode because he wanted to do it too. And he said he just finished listening to our covered call debate episode. A lot of valuable info as always. He wants to give this a try as well. So a lot of people chiming in on the wheel, Dan. We also had Chasing That Paper. He says he wants to sell cash secured $6 puts, and if assigned, to sell a 70 delta call. So he's trying to figure out the methodology as well. He wants to know if he can only do it in AMC, if he can apply that methodology to any other stock, any 50 delta or different delta for selling. If you don't sell at the money, it's going to be a 50 delta. They're Chasing That Paper. So there's a lot of people looking. They were intrigued by that episode, Dan, and maybe came away from it not even looking at covered calls, but more looking at the wheel now, because I know you and Matt got even more into it intense. I definitely had to keep you apart on the wheel. You were both just coming to blows on the wheel, Dan. So apparently a lot of people coming away from that episode liking the wheel. They're applying it to AMC and maybe some other names. Dan, what do you think?
Yeah, it is interesting. A lot of my use case for it is sort of, plain old boring, long buy and hold, long-term buy and hold stocks. But I have done it on some of these more volatile stocks that have super high implied volatility. And it can work really, really well. I think if I'm reading this right, there might be a typo in his first thing here, a 70 delta in the money call. I think he means, oh, no, that's probably right. Yeah, I'm sorry. That's not a typo. Yeah, I mean, if it works, do it. Know your risk. Know what bogeys are hiding in the closet. And yeah, man, it's a good strategy if you have a good solid plan and you know what you're going to do after X, Y, and Z happen. You war game the scenario out. So great, yeah. I'll say the same thing to you, Diver SK. Fill us in, in a couple of months after you've got a couple of these trades under your belts, and let us know how it's gone.
Yeah, it's interesting. I'm just looking at some historical skew data for AMC while you're talking as well. Right now, they're at only the 12th percentile for the year in terms of skew. So the puts aren't that bid, listeners, and the calls aren't that offered. So you're not getting a ton of juice for those puts that you're selling out there. Just bear that in mind. So some of these valuations you're extrapolating out for the year, obviously they're going to change depending on how the skew evolves. If you're curious, by the way, the height for skew 322.4%. That's a lot. It's 91.7 right now percent, and it's only at the 12th percentile. The height came on August 25th, 322. Man, you're getting a lot of juice for those puts then. And the low came on May 17th, 77.6%. Even at the lows, those calls sound like they still have a decent amount of juice in them. So a little bit of a vestigial remnant of the 2021 meme stock days. But intriguing. Just bear that in mind as you're selling these puts and extrapolating out for the whole year. Obviously, those income levels are going to change based on the vol, based on the skew setup. So it's kind of hard to extrapolate for a full year. But as Dan said, I'm curious what your results are, Diver, and anyone else, Just John, anyone else who tries this. And also, if you try it on other names outside of AMC, hit us up. Let us know. We're curious what your results are. At the end of the day, everyone's listening to this. Everyone's trying to learn along with everybody else. So if you hit on something interesting that works for you, maybe it doesn't. There's information in that as well. Let us know. And we want to discuss it here on the show. All right, Mr. Dan, that music means we have come to the end of the second part of our doubleheader. Man, an hour and change flies by when you're having fun and talking about Blowout, Butterflies, and Devil's Bargain, Mr. Dan.
Yeah, we talked about some interesting stuff this time around. Well, thanks for listening, folks. And you know where to reach me, marketicker.com. Glad to help in any way I can. And sounds like we'll be seeing you shortly on a upcoming Wednesday of your choice.
You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.